Staring at flashing charts all day is exhausting, especially if you're trying to fit trading around a full-time job. Constantly checking your phone for price updates is a fast track to burnout, but you can step away from the noise. We're going to build a rule-based 5-step trading system that requires no more than 30 minutes of chart analysis a day. You set your orders, and then you walk away. Step 1 is setting up your environment. Open your charting platform and pull up a major currency pair. For this walkthrough, let's use the euro against the US dollar. Next, lock your chart timeframe strictly to the 4-hour mark. Lower timeframes are filled with erratic movements and fakeouts designed to trap retail traders. The 4-hour chart filters out that noise and reveals the actual sustainable trend. Once a trend starts on the 4-hour chart, it has the strength to continue. Mastering this single time frame is how you stop trading your time for screen time and start making clear, objective decisions. Let's get into the checklist. Criteria number 1 is finding a valid break of structure, or BOS. This defines the exact direction the market wants to go. This drawing shows the theoretical path of a break of structure. In a bullish trend, the price continually breaks previous highs. In a bearish trend, it falls below previous lows, creating a downward staircase pattern. This chart shows the critical difference between a continuation and a trend change. Notice how the structure breaks to continue the trend, but a sudden break of the last structural low or high flips it entirely. We will trade both scenarios. Looking at these real candlesticks, we see 3 consecutive structural breaks mapped out. The price clearly creates a new level, pulls back, and then breaks through again, validating the overall market direction. This image shows the most common trap, a wick break. For a break of structure, the candle body must close above or below the line. A wick piercing the level without a body close means the structure holds, invalidating the setup. Step 2 is the liquidity sweep. Banks need sellers, finding them where retail stop losses are clustered. The market drops below a previous low to trigger those stops, collecting liquidity before reversing to continue its real trend. A confirmed break of structure paired with a clear liquidity sweep tells you that institutional money has entered the market and committed to a direction. Now we need proof of momentum. Step 3 is verifying the trading volume to ensure that our structural break has real force behind it. This schematic shows true institutional volume. We want to see 3 consecutive aggressive candlesticks moving in the same direction. When distinct gaps form between the wicks of these candles, you know heavy buying or selling pressure is present. That massive volume leaves a physical footprint on the chart. Step 4 is marking the order block. To locate the order block, find the last opposite-colored candle before the massive volume push began. Draw a box around the entire body and wick and drag it forward. This zone is where institutional orders originated. If your break of structure happens without that strong volume gap or a clean order block, ignore the setup. The market will likely drop back down to take liquidity again. By mapping this precise order block, we translate abstract institutional momentum into a specific actionable target zone on our screen. Our zone is marked. Step 5 is customizing our Fibonacci retracement tool to catch the exact entry and place our limit orders. Open your Fibonacci settings and turn off all the default numbers. You only need 3 specific lines active: the 0, the 0.71, and the 1. Everything else is clutter. Take your customized tool and drag it from your recent swing high down to the swing low of your identified structure. Notice how the 0.71 line perfectly intersects with the order block zone we just drew. To maximize our probability of a fill, we use a split order method. We're going to set up 2 separate limit orders, risking exactly 1% of our account on each. Place the entry for your first order exactly on that 0.71 Fibonacci line. Then place the entry for your second order right at the front edge of your order block box. Now lock in your safety parameters. Set both of your stop losses at the Fibonacci 1 line. Set both of your take profits at the Fibonacci 0 line. Splitting the entry this way secures a mathematical edge, averaging out to roughly a 1 to 2.45 risk-to-reward ratio. Your risk is capped, your target is set, and real-time emotional decisions are completely eliminated. Let's review the final chart. We have a solid gaudy break of structure, a clear liquidity sweep, 3 strong candles of volume, a mapped order block, and our Fibonacci limit orders are live. All 5 criteria are checked. This is where you close your laptop. Your work is done for the day. You don't need to micromanage the trade. Let the 4-hour time frame do the heavy lifting while you go to your job or spend time with your family. The market will now do one of two things. It will either trigger your orders and hit your targets, or it won't. Either way, you have removed chart anxiety from the equation entirely. Trading doesn't have to consume your life. Rigid simplicity and strict criteria are your real path to freedom. And if you want to make this setup even stronger, stick around. In the next video, we'll cover the optional 6th step, finding extra liquidity.